Let's start with Chapter 7. Passive income from real estate. Real estate is one of the most lucrative source of passive income. Investment in real estate at right time and right place can give good appreciation in property value, good passive income in the form of rent. Real estate is not that liquid and there are huge commissions or stamp duty registrations to be paid for property buying and selling. This opportunity requires lot of study and one cannot blindly invest as the quantity of money required for real estate buying and selling is large. Rental is a main source of passive income while investing in property. So calculation of proper return of investment is very important while shortlisting any property. Returns anywhere between 3 to 5% per annum in India are good returns. Investor can also take loan to invest in real estate if returns are very lucrative and property loans are cheapest loans available in the market. Portfolio management services. The portfolio is a collection of investment instruments like shares, mutual funds, bonds, fixed deposits, and other cash equivalents, etc. Portfolio management is the art of selecting the right investment tools in the right proportion to generate optimum returns from the investment made. In other words, a portfolio is a group of assets. If compared, generally it is found that the risk attached to an asset is more than the risk of portfolio. This is because portfolio gives an opportunity to diversify risk. Diversification of risk does not mean that risk will be eliminated. With every asset, two types of risk are attached: diversifiable risk and market risk. Even an optimum portfolio cannot eliminate market risk, but can only reduce or eliminate the diversifiable risk. As soon as risk reduces, the variability of return reduces, leading to better and assured returns. Best portfolio management practice runs on the principle of minimum risk and maximum return within a given time frame. A portfolio is built based on investors' income, investment budget, and risk appetite, keeping the expected rate of return in mind. Objectives of portfolio management. When a portfolio is built, following objectives are to be kept in mind by the portfolio manager based on an individual's expectation. The choice of one or more of these depend on the investor's personal preference: capital growth, security of principal amount invested, liquidity, marketability of securities invested in, diversification of risk, consistent returns, tax planning. Investors hire portfolio managers and avail professional services for the management of portfolio by paying a pre-decided fee for these services. Let us understand who is a portfolio manager and tasks involved in the management of a portfolio. Who is a portfolio manager? Portfolio manager is a person who understands his client's investment needs and suggests a suitable investment mix to meet his client's investment objectives. This tailor-made investment plan is recommended keeping in mind the risk-return balance. Passive income from business empire. Take example of all the big tycoons: Mukesh Ambani, Lakshmi Mittal, Bill Gates, Carlos Slim Helú, all created business empires. Once business grows at level that systems become autopilot, then these creators don't have to look after small day-to-day operations of business. Once business is created in an autopilot mode, we can have excellent passive income from such business operations. Even small business like wine shop, where owners set up shop and give it for management to manager, which keeps giving passive income to owner. There are lot more retail business which operates on same autopilot model, which gives good amount of passive income to investor. There are a lot of manufacturing or assembly units which run on the same model, which keeps giving passive income to the owner. There are many hotels or lodges where we have never seen owner and still it makes a lot of income for the owners. These owners at times act as sleeping partners and invest in the project and give it to someone to handle it. Income is shared with such sleeping partners on shared ratio. There are a lot of business where either you act as a sleeping partner or owner and it doesn't require your time. Below is a case study where we try to explain passive income opportunities from different sources in a single example. Create enterprise for passive income. Kamal has started one company called XYZ, who will be in the business of providing digital marketing solutions to corporates. Kamal has initial capital of only INR 2 lakhs and required INR 2 lakhs to start the company. So he borrowed remaining INR 2 lakhs from his friend Rahul at interest of 2% per month. Kamal's 2 lakhs plus Rahul's 2 lakhs, XYZ company value 4 lakhs. Passive income opportunity for Rahul. As Kamal is his good friend, he didn't mind giving loan to him at 2% per month. By doing nothing and with some amount of risk that if Kamal doesn't return his money, he would earn passive income of INR 4,000 per month. So the business started with INR 4 lakhs company. XYZ fixed expenditure is around INR 80,000 per month. Company's capital when started. Owner's capital 2 lakhs. Loan 2 lakhs. Total 4 lakhs. Capital in hand 4 lakhs. Within months, they got couple of clients and now their income started coming in. The business started flourishing. Company worked quite hard during initial phase and got good set of clients. Revenue started coming in rapidly. After a year, the company started doing well. Valuation of the company grew to 40 lakhs. Clients started coming in rapidly and now there was a need for more money. There was order which required them big team and big capital. They required further capital of 60 lakhs. So Kamal approached bank for loan, but bank found it is too early for them to come and apply for loan. So Kamal spoke to some personal contacts and one of his friends' company got ready to invest in this project. So ABC company got ready with a term that they needed ownership in the company. Kamal got ready to give them 40% ownership in the company. So now whatever profits will be there, 40% will have to be shared with ABC company. This type of investment is called private equity investment. Passive income opportunity for ABC company. By investing in company through private way and by seeing scope in the company, ABC got equity, ownership of 40% shares in the company. Such type of investment is called private equity investment. For ABC, it is passive income as they will not be involved directly into business operations. So after 2 years, company's position was owner's capital 38 lakhs, loan 2 lakhs, ABC private equity 60 lakhs, total 1 crore, capital in hand 1 crore. Company banked on to expansion plans and they started gaining goodwill in the market. Value of the company got increased to 2.2 crores after end of second year. Their clientele started increasing. Scope of digital marketing got saturated where they realized a need to come to different vertical of software development which required further capital requirement of 1 crore. XYZ went to bank for loan but still bank was not comfortable giving them loan. Kamal again started meeting different companies. Kamal met one merchant banker who suggested him to issue debentures of the company. They enter into contract with that merchant banker to help them raise capital through debentures of 1 crore. Meaning of debentures. A debenture is a type of debt instrument that is not secured by physical assets or collateral. Debentures are backed only by the general creditworthiness and reputation of the issuer. Both corporations and governments frequently issue this type of bond to secure capital. Like other types of bonds, debentures are documented in an indenture. Debentures have no collateral. Bond buyers generally purchase debentures based on the belief that the bond issuer is unlikely to default on the repayment. An example of a government debenture would be any government-issued treasury bond, that is T-bond, or treasury bill, T-bill. T-bonds and T-bills are generally considered risk-free because governments at worst can print off more money or raise taxes to pay these types of debts. Debentures are the most common form of long-term loans that can be taken out by a corporation. These loans are repayable on a fixed date and pay a fixed rate of interest. A company normally makes these interest payments prior to paying out dividends to its shareholders. Similar to most debt instruments, In relation to other types of loans and debt instruments, debentures are advantageous in that they carry a lower interest rate and have a repayment date that is far in the future. So company issued bond to raise INR 1 crore at 12% per annum from market. Passive income opportunity for debentures owners. Anybody who buy debentures of company will earn at the rate 12% per annum. These type of investors prefer some fixed returns against their investment. They expect returns more than fixed deposit with banks, and that is the reason they carry certain amount of risk. After raising funds through debentures, end of third year, company's position, owners, promoters capital 1 crore 30 lakhs 80,000. ABC Private Equity 87 lakhs 20,000. Total 2 crores 18 lakhs. Loan Rahul 2 lakhs. Debentures 1 crore. Total 1 crore 20 lakhs. Capital in hand 3 crores 20 lakhs. Company did extremely well after 3 years. Sales boosted because of good product penetration. Quality of team was excellent. Owners had a board meeting where they decided to go in full flow for next 2 years. So next 2 year company recruited teams from competition with few more product mix. Company planned to expand in USA and European market after 5 years, where they required good amount of funds. After 5 years, company's valuation was around 19 crores and company needed around 11 crores for expansion in foreign markets. Again, company went to bank and they got ready to give loan of only INR 3 crores, which was not going to help out. Kamal met merchant banker again, who suggested him to raise money by giving shares to general public and raise capital from the market. So he suggested to raise money through IPO. Meaning of IPO. An initial public offering, IPO, is the first time that the stock of a private company is offered to the public. IPOs are often issued by smaller, younger companies seeking capital to expand, but they can also be done by large privately owned companies looking to become publicly traded. In an IPO, the issuer obtains the assistance of an underwriting firm, which helps determine what type of security to issue, the best offering price, the amount of shares to be issued, and the time to bring it to market. Through IPO, capital is raised through book building process where anyone from open public feels that XYZ company is doing quite good and expanding, and there are chances that if he invests in that company, his capital will rise as the company grows. Normally, each share is given for ₹10, which is called face value of share, and XYZ is already doing good business and expanding. They give shares to open public at premium. So normal investor has to pay face value plus premium is equal to bid or offer price. Bid and offer price is the price between which investor gets his shares. Company's position before raising money from market after 5 years. Owners, promoters capital 10 crores 78 lakhs 80,000. Percentage 60%. Number of shares 6 lakhs. ABC Private Equity 7 crores 19 lakhs 20,000. Percentage 40%. Number of shares 4 lakhs. Total 17 crores 9 lakhs 80,000. Loan Rahul 2 lakhs. Debentures 10 crores. Total 10 crores 20 lakhs. Capital in hand 19 crores. In XYZ example, suppose company decided to approach merchant banker to help them raise capital through IPO, which is said to be company raising funds from primary market. Company decided to give 40% shares to public, from which Kamal will give 20% and ABC will give 20%. Suppose company has initially issued 10 lakh shares. Company got very good response from investors in open market and raised good money through IPO. In fact, IPO got oversubscribed by 5 times. Oversubscription means if there is demand to sell 4 lakh shares in primary market and 20 lakh applications have come to issue shares. So after book building process and giving shares to public, XYZ company will look like this. Look at that. Owners, promoters capital 11 crore 56 lakhs 80,000. Percentage 40. Number of shares 4 lakhs. ABC Private Equity 5 crores 78 lakhs 40,000. Percentage 20%. Number of shares 2 lakhs. Public 11 crores 56 lakhs 80,000. Percentage 40%. Number of shares 4 lakhs. Total 28 crores 98 lakhs. Loan Rahul loan rupees 2 lakhs. Debentures 1 crore. Total 30 crores. Equity share or stock meaning. Equity shares are the main source of finance of a firm. It is issued to the general public. Equity shareholders do not enjoy any preferential rights with regard to repayment of capital and dividend. They are entitled to residual income of the company, but they enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. The main features of equity shares are: they are permanent in nature. Equity shareholders are the actual owners of the company and they bear the highest risk. Equity shares are transferable, that is, ownership of equity shares can be transferred with or without consideration to other person. Dividend payable to equity shareholders is an appropriation of profit. Equity shareholders do not get fixed rate of dividend. Now suppose Raju has applied to buy 100 shares of XYZ through IPO and got 20 shares as the IPO got oversubscribed by 5 times. As per valuation, he would get share for Rs 290 from primary market. Before going for book building process and raise money through IPO, XYZ has to do a lot of formalities. It has to take permission from SEBI, who is regulatory body formed to safeguard interest of investors in India. Also, they have to give application to list on exchange where shares of XYZ will get traded. XYZ is given a date where it will be listed on secondary market, that is, stock markets like NSE and BSE for trading. So if investors miss out to buy shares of XYZ through IPO, they can buy it from secondary market as well. Once the share will get listed on exchange, it will get open for general public for trading henceforth. If demand for XYZ is very high, is secondary market as well, it will open much above than the bought price of INR 290 in primary market. But if people feel that the growth of XYZ is not that much, they will not buy share in secondary market and share might open at the rate lower than primary market. We will assume that public sentiment for XYZ is very positive because of growth story of XYZ. Then share will open at much higher price. Suppose shares open at 10% higher than price from primary market, that is 290 plus 29 is equal to 319, then investor in secondary market will get this share for INR 319. And ones who bought this share in primary market for 290 can sell it at 10% profit. This is beauty of stock market. It is demand and supply game which investors have to predict and act upon. Also, equity shareholders get profits of the company in the form of dividends. Passive income opportunity for equity share owners. Equity market is a huge market where lots of passive income could be earned. Timing to enter into stock and prediction about future is very important before investing into stock market. If it goes wrong, may result into huge losses. Just imagine someone on entire company works for you day and night to make you rich. They launch new products, do sales, make strategies, do requirement just to make you rich. That is the power of share investment. Then you buy it through IPO or stock exchanges, it doesn't matter. Equity shareholders also get share of profits of the company in the form of dividend. In above example, just imagine how rich would Kamal be if stock trades for INR 350. He would be sitting on capital of INR 40 lakhs into 350, which is 1400 lakhs, a guy who started with a base capital of INR 2 lakhs. This case study is hypothetical, but there are a lot of things which can be noticed. Rahul, who shared at very first stage when the company was too small, still get interest at fixed rate or maybe little bit more if interest rate is raised a bit. He seems to be a very conservative investor who is happy with fixed but safe investment. ABC company, which enter in earlier stage, got huge appreciation in capital as they had taken risk in newly started up company which was showing sign of great growth. They participated at every level in the growth of company and are one of the major beneficiaries in the growth story of the company. Point to note that if something goes wrong with the company, they will be major losers as well. Since they hold equity, that means they are direct beneficiaries of profits as well as losses. Like Rahul, debenture owners also get returns on some fixed rate. They are also conservative investors who prefers to invest money on interest with some company at higher rate than with bank at lower interest rate. In such a wonderful growth story, even their returns of investment is fixed to the interest rate which was decided. Shareholders are ultimate beneficiaries of growth of company. They require to study hard on what should be the entry level and exit level of the company. Share owners get maximum benefit on growth story of the company. Share investment is ultimate source of passive income as investor gets appreciation as well as dividends, share of profits. Here we complete our chapter.